Last time, we uncovered how a quiet, almost invisible force inside India sent shockwaves across the global silver market. How everyday decisions, a family buying bangles, a jeweler stocking for Diwali, a factory securing raw materials, combined into one of the most powerful demand waves in modern economic history. But what happened next surprised even the experts. Because India didn't slow down, it didn't pause, it didn't wait for corrections, dips, retracements, or pullbacks. Instead, something extraordinary occurred. As silver prices climbed to the highest levels ever recorded in rupee terms, prices that should have cooled demand, discouraged purchases, and throttled consumption, Indian demand did the opposite. It accelerated. And not because of speculation, not because of fear, not because of a sudden mania sweeping financial markets, but because of something far deeper, something cultural, something emotional, something structural, something economic, all converging into a single unstoppable force. This is the moment in our story where traditional economics breaks apart, and India replaces it with a logic entirely its own. A logic that kept jewelers working late into the night, even as global traders stared in disbelief. A logic that emptied inventories across Asia and the Middle East faster than refiners could replenish them. A logic that forced silver bars to be flown by air, not shipped by sea, because buyers in India were no longer willing to wait weeks or even days. When silver becomes expensive, most of the world steps back. But in India, millions step forward. And that single behavior, this deeply rooted instinct to buy into strength, triggered a chain reaction that spread across the globe. Dubai's reserves thinned. Swiss refineries fell behind schedule. China reversed its flows and began exporting silver to relieve pressure. And COMEX inventories in New York plunged at one of the fastest rates ever recorded. This wasn't sentiment. This wasn't speculation. This wasn't a temporary spike. This was the emergence of a new gravitational center in the silver market, a force large enough to reshape global price discovery in real time. So in Part 2, we go deeper. We explore the puzzle that left economists baffled. Why did India buy more silver at record-high prices than it ever bought at the bottom? Why did households, jewelers, and industries increase their purchases exactly when the metal became the least affordable? And then, we follow the aftermath. As India's demand radiated outward, pulling metal from global vaults, consuming refinery output, draining buffers that had taken years to build, and forcing the world's logistics networks into emergency overdrive. Because when 1 billion people choose certainty over price, tradition over volatility, and survival over delay, the rest of the world discovers something unsettling. There is simply not enough silver to satisfy India and everyone else. This is no longer a spike. This is no longer a seasonal surge. This is a structural shift, a rebalancing of global silver flows that may define the next decade. So welcome to Part 2. Let us begin with the moment the world realized something fundamental had changed. A moment that starts with a simple, haunting question. Why did India buy more silver at the top than it ever bought at the bottom? Let's explore. Hello there. I'm Professor Edmund Hallberg. For more than 4 decades, I've been wandering through the worlds of history, economics, psychology, and technology, trying to understand why humanity keeps repeating the same grand mistakes while hoping for better outcomes. Now let me show you the moment that truly stunned the global financial world, the moment that made analysts, miners, and traders all ask the same question. What on earth is happening in India? Because India did something absolutely counterintuitive, something that broke every traditional economic model. They didn't buy silver because it was cheap. They bought silver when it was the most expensive it had ever been. 1.5 lakh rupees per kilo, 1.7 lakh rupees, 1.8 lakh rupees, and climbing. These were prices that should have cooled demand. These were prices that normally send buyers running for the exits. But in India, demand didn't fall. It accelerated. This was the puzzle Western analysts couldn't solve. In Chicago, London, and New York, rising prices are usually a warning. Be careful, something is overheating. But in India, rising prices send a very different message. Something strong is happening. Silver is asserting itself. Buy before it goes even higher. Why Indian demand behaves differently, the cultural engine. In the West, precious metals are often treated like assets on a spreadsheet, numbers that move up and down on a trading screen. In India, silver is something else entirely. It is a gift at weddings, a blessing during Diwali, a form of savings, a symbol of prosperity, a hedge against uncertainty, a tradition inherited over centuries. You don't wait for prices to fall during a festival. You buy because the festival demands it. A daughter's wedding doesn't move because COMEX prices moved. A family gift doesn't wait for consolidation or retracement. Ceremony, culture, and ritual overpower volatility. So when silver prices hit record highs, instead of stepping back, millions stepped forward. Because in India, rising prices do not signal danger. They signal momentum, strength, confidence. Silver, the affordable safe haven. And then there is the most overlooked factor of all. Gold has become too expensive for many. But silver, even at record highs, remains the affordable safe haven. For a middle-class family, gold requires years of savings. Silver requires a decision. Gold is a luxury. Silver is accessible. Gold is out of reach for many. Silver is a bridge to financial security. So while gold soared beyond 60,000 rupees per 10 grams, silver remained the metal that millions could still buy, store, gift, and accumulate. It is safety within reach. Investors trust what they can hold. Another subtle truth emerged, one deeply psychological. Indian investors, especially outside major metros, trust the metal they can touch. Bars, coins, jewelry, physical silver, not digital entries on a screen. In a world of unstable currencies, uncertain markets, and rising inflation, the ability to hold your wealth in your hand is not quaint. It is rational. No hack, no counterparty risk, no bank glitch. A lesson reinforced when the CME's platform went offline during a rally. When the screen goes dark, physical metal becomes everything. Rising prices, more demand, not less. And so the classic Western rule that higher prices reduce demand breaks down completely. In India, rising prices create a psychological cycle. Silver is strong. The trend is up. Buy before it becomes unaffordable. Economists call this a positive feedback loop. In India, it's just common sense. And when local inventories emptied, something even more remarkable happened. Families, jewelers, investors, and factories were willing to pay premiums of 5, even 10% over the global price simply to secure the metal. Premiums that shocked London vaults. Premiums that drained COMEX. Premiums that forced refineries to divert shipments. Because this wasn't a market-chasing speculation. It was a nation defending tradition, security, and economic momentum. This wasn't emotional buying. This wasn't hype. This wasn't a bubble. This was cultural, structural, and deeply rooted, a form of demand that does not obey standard financial logic. And that is why India's silver buying at record-high prices left the rest of the world speechless. Because when 1 billion people decide that rising prices mean buy now, the global supply chain simply cannot keep up. This is the moment where our story stops being national and becomes undeniably global. Because when India began buying silver at full force, the impact didn't stay within India's borders. It ricocheted across continents, hitting Dubai, Zurich, Shanghai, New York, and London almost simultaneously. Let me show you how a single country's demand rippled through the entire global supply chain. 1. Dubai, the first shockwave. Dubai is one of the world's busiest physical silver hubs, a gateway between East and West, a free-zone trading corridor where refiners, jewelers, and wholesalers move metal at lightning speed. When India's demand surged, Dubai was the first to feel the pressure. Inventories began to drop. Dealers reported shortages. Premiums rose overnight. Shipments meant for other markets were suddenly redirected to satisfy Indian buyers. It was the first clue that this wasn't a normal demand spike. This was an international scramble. 2. Switzerland. Refiners couldn't keep up. Next came Switzerland, home to some of the most trusted precious metal refiners in the world. Swiss refineries are accustomed to large throughput, but India's orders pushed them beyond typical capacity. Backlogs grew. Production schedules were extended, and what metal they could refine was quickly snapped up by Indian distributors. The refiners simply could not keep up with the relentless buying pressure. This wasn't just strong demand. This was industrial-scale extraction of global supply. 3. China, a surprising reversal. And then something almost unheard of happened. China began exporting silver. China, normally a massive consumer of silver for electronics, solar panels, and industry, actually pushed metal out into the world to ease the shortage. Bloomberg and Reuters both noted this anomaly. China exporting silver at a moment when global inventories were collapsing. This is not normal market behavior. This only happens when demand somewhere else, in this case India, becomes so extreme that every available ounce must be mobilized. 4. New York. COMEX. Inventories plunged. But perhaps the most dramatic shock came in New York. COMEX, the world's most monitored silver exchange, saw inventories fall by over 20 million ounces in just 2 weeks. That is a staggering number. Vault managers watched metal disappear at a pace they had rarely seen before. Bars that had sat comfortably in storage suddenly had destinations. Mumbai, Ahmedabad, Delhi, Hyderabad buyers in India were outbidding others globally, pulling metal out of the U.S. system far faster than normal. Even traders who had lived through the 2011 silver spike were astonished. 5. London, the heart of the global system under pressure. And then we arrive at London, the lbma vaults. London is the central nervous system of the global silver market. Good delivery bars, ETF reserves, institutional holdings, settlement stock, industry buffers, and yet. In 2024 and 2025, even London began to show cracks. Phil Baker said it plainly in the interview, "If you look at where the silver from London went, it went to Mumbai." This is astonishing. London is not supposed to feel pressure. The lbma is the ultimate liquidity pool, the deepest, most stable inventory center in the world. But India's buying pace was so aggressive, so immediate, so unrelenting, that even London struggled to keep metal in stock. 6. And then, the airlift. When Bloomberg reported that silver had to be flown by plane between financial hubs to meet demand, analysts understood the severity of the situation. Flying silver is expensive. Flying silver is inefficient. Flying silver is only done when the system is under severe strain. And yet, this is exactly what happened. Shipments moving not by sea but by air, because buyers in India were not willing to wait. This is not normal. This is crisis-level logistics. 7. Why did everything break? The 5-year deficit. To understand why this happened, we must look at the foundation. The world has been running a silver deficit for 5 consecutive years. 2021, deficit 2022, deficit 2023, deficit 2024, deficit 2025, deficit expected again, each deficit in the range of 100 to 200 million ounces. For 5 years straight, humanity has consumed more silver than it produced. Inventories had already been thinning. Reserves had already been stretched. The system was already fragile. And then India, the largest physical consumer on Earth, pushed demand to the limit. 5 years of structural deficit met 1 year of explosive Indian demand, and global inventories broke. The moment the silver world changed. This is the moment analysts now point to as the turning point, a moment when Dubai ran low, Switzerland fell behind China, reversed flows, COMEX was drained, London felt stress, airlifting became necessary, and supply chains scrambled to survive. All because one country, at the exact moment the global system was weakest, began buying at historic scale. India didn't just participate in the global silver market. India reshaped it. So by now, the picture is unmistakable. We've watched how Indian families, jewelers, and factories kept buying even as prices hit record highs, how cultural conviction overpowered volatility, and how a nation's instinct to secure metal at any cost, at any premium, tore through the quiet assumptions of the global supply chain. We've followed that demand as it raced outward, draining inventories in Dubai, overwhelming refiners in Switzerland, flipping China from net buyer to unexpected supplier, and knocking more than 20 million ounces out of COMEX in just 2 weeks, until even London, the deepest, most liquid silver center on Earth, felt the strain. This is not the story of a speculative bubble. It is the story of a system that was already in deficit, finally colliding with a buyer that does not flinch. And when that buyer is a nation of 1.4 billion people, with rising incomes, expanding industry, and festivals that do not wait for better entry points, the usual rules of the market simply stop working. The world has discovered a hard truth. You cannot have 5 years of structural silver shortages and then add India's full-strength demand on top without something breaking. We have just watched where it broke, in inventories, in logistics, in leasing rates, in the quiet panic behind the scenes. But there is still one question we haven't fully answered. Not just what India is doing to the silver market, but what that means for the future. Because if India is now the country that drains vaults, moves premiums, and forces metal to fly across continents, then India isn't just another participant. It's something else. In our next chapter, Part 3, we're going to ask a sharper, more uncomfortable question. Has India become the true driver of the global silver price? We'll look at why veterans like Phil Baker say, India is the driver. That is literally it. We'll unpack what it means to be the marginal buyer, the player whose decisions set the tone for everyone else, and why, in silver, that role may now belong to India. Because if that's true, then the future of silver, its shortages, its surges, its new normal price, will depend less on what happens in New York or London, and far more on what happens in Mumbai, Jaipur, Ahmedabad, and 1,000 other places across India. Join me in Part 3, As we answer the question the whole market is quietly circling. What happens when the world's most important silver buyer sits thousands of miles away from the trading floors that still think they're in charge?